Hello, everyone, and welcome to tonight's webinar on Use It or Lose It, the countdown to year-end planning begins. My name's Tom Ahola. I'm one of the advisors, realtors, and overall just kind of real estate people going on here at Marshall Reddick. I would love to introduce you to Tony tonight. He's going to be speaking on tax planning in general. Tony?
Perfect. Hey, thank you so much. Really appreciate you all having me. Thanks, Tom. Thanks, everybody at Marshall Reddick for including Robert Hall and Associates in marketing endeavors.
All right. Well, thanks. For those don't know, Tony works at Robert Hall and Associates, and they're pretty much one of the go-tos that we've been using for many years. They help a lot of our investors with a lot of creative tax planning solutions and just kind of overall things in general about how to utilize your money well. So without further ado, again, thank you everyone for coming in. Wow, there's actually a lot of people coming in. Thank you for taking time out of your busy schedules on this Tuesday to join us. And by the way, before we get really into the slides, I want to let everyone know that if you have any questions, please do write them in the question box and we will get those questions answered after the webinar. We don't answer questions during, otherwise we wouldn't be able to condense all that wonderful information to you. But we have a follow-up schedule where we get those questions answered afterwards. So don't feel like we're ignoring you. Just feel free to leave them in the question box and we will get to them and follow up and give you our full attention. So, all right. I'm sure a lot of people that are here, I know this because I've talked with you, a lot of longtime Marshall Reddick attendees here tonight, a lot of people from 2002, 2000 earlier. But for those of you who are Marshall Reddick clients or are first timers, we just want to let you know a little bit about us as a company. We like to say that we're kind of the full hat trick. We do all three things. Actually, we tossed a fourth in, but all three things that you really need to operate in investment real estate. That is a real estate brokerage. That's what I myself do. I am a local agent here in Newport Beach, as well as a advisor kind of quarterbacking deals out of state, where we have offices in every state. We have every state that we operate in, rather. I'll get into that later. We also do property management, which if any of you who are here, you know that that's the biggest pretty much pain point in any investor's portfolio is you can buy a deal all day long, but if you don't manage it effectively, that extra 2 months of vacancy, that's your whole year's return. We also do private money lending. So a lot of people, as you know, you've been in pinches with certain deals. We often help with those. We've got all kinds of different loan programs, which you can see on the website. And what's great is it's all in-house for all three of these services. So we keep it all under one roof. It makes all of your real estate investing so easy and seamless. If you got an issue with one, you call me up, let me know, hey, I need some money, we got to get a loan. I literally jump up, talk to somebody 4 desks away. Makes it real fun. We also have the investment fund, which has actually been a conversation that's coming up more and more nowadays, which please feel free, again, write a question if you want to know about it. Private placement equity mortgage fund, where it is all first trustees. A lot of great information on that. Anyways, we make it possible to purchase residential real estate in carefully selected areas in the United States. Our organization provides real estate brokers, contractors, property managers, and access to top resources such as lenders, CPAs, insurance agents, attorneys, and much more, like our friends at Robert Hall. Now, a little bit about me. A lot of voice here, not so much face, so there's my face. My name's Tom Ahola. As I said, I'm an advisor and realtor here. I assist clients both in state and out of state with single family and multifamily transactions. I personally am really passionate about local Southern California multifamily residential property here, but I'm well versed in pretty much every transaction you can imagine to do with all of the book of business we operate here. I'm a licensed California realtor, of course. You kind of have to be selling real estate, but I also have my degree in real estate. Now, that's not a hard knocks degree. That's a piece of paper from a college. They had an associates of real estate program, and it was, let's just put it, the couple of semesters, the only semesters I made Dean's List because I was so passionate about it. I also come from a family of educators. I do have a passion in education. So, you know, what my fifth grade teacher mom would always say, there's no such thing as a dumb question. Do not feel afraid to ask anything, you know. That's why we leave that comment section for you. So leave us any questions that you might have about anything, and we will get them answered in full. Here's what I was talking about prior about the markets that we operate in. Now, the green areas are where we actually have offices. Those are when I say we have offices, we have brick and mortar locations with brokerage, full service brokerage, agents for transactions, buying, selling. We also have the property management team and staff set up in each of those green box locations with specific leasing agents who all they do is lease properties. All the property management does is property manage. The reason why we have those brick and mortar locations set up is because it keeps the accountability so high, right? Again, like I said, if you've got an issue, you just come to your quarterback, you come to me, and we get those problems solved for you. Okay, we also have a lot of referral partners. I've done a couple deals in Boise, couple deals in Phoenix, couple in Memphis, couple in Indianapolis, couple in Dallas. I mean, there's a, you know, pretty much, I'd like to put it this way. If you own property in any of the other states, really, and you're looking to transfer that into one of the states that we operate in, we can handle that too. But we do buying and selling in each of these states listed. And then, of course, a lot of people ask, why do we operate in these markets? That's always question number one. Hey, man, I'm looking in Ohio. Hey, man, I'm looking in Alaska. Hey, man, I'm looking in Hawaii. Why did Marshall Reddick choose these markets to invest in? Well, I'm sure as a lot of people, you know, my grandfather used to always tell me, follow the jobs. You know, we look at job markets. So that is definitely answer number one, is the job markets. What kind of employment is in each of these cities? That's like San Antonio. If any of you read the information packet on San Antonio that we provide, you can see exactly how many different kinds of employers there are, which is huge. We also look at a vacancy rate. We want a low vacancy rate. Low vacancy rate means low vacancy in general, and what that also means is less money out of our landlords' pockets. When you look at a spreadsheet over time, you want to see the one with the 4%, 5%, 8%, rather than the place that's got a 20% vacancy rate, and there's places that do. We also look at economic diversity, and that kind of ties into the whole job market thing, because guess what? If you're investing in a small town that's got great cash flow, but all they've got is the tractor factory and that place goes out of business, all of a sudden your cash flow doesn't look too hot. So we look for places that are essentially what we like to say a little bit recession resistant, because they've got so many different jobs that aren't necessarily going to be affected in times of uncertainty. We also look for housing affordability. I'm sure if any of you live in Southern California like I do here myself, you're not going to live any place you want to live for less than $1 million. We look for markets where it doesn't cost nearly that. And the reason for that, of course, is quality of life. I gotta, work really, really hard to afford nice things versus a lot of the other markets that we have these investments in, where people can afford a very nice rental that you own for $250,000, $300,000. And they're very happy to pay that, and they still have a great quality of life. So they're more of an A-class tenant and take care of the property. I'll explain A-class in a little bit as well. We also look for landlord-friendly states. There's a question mark behind that because a lot of people wonder what that even means. If you own any real estate here in Southern California, you will know. The landlord is always wrong. The tenant is always right in California. We decide to sell a lot of real estate in a lot of states where, guess what? If they're not paying, if they've got an issue, if you need to actually manage your asset effectively and you don't want to be taken to court over a problem that really shouldn't be taken to court, we look for states that are more on the landlord's favor, places where you can actually effectively manage your assets. We also like markets where we have a strong education, points 1 through 5, and the reason why I can explain them so effectively is the same reason why we operate in these markets, because we are well educated in every single one of these places. We've got things called market data packets. If you have any questions in any of these markets, I can send you one. It's this giant PDF booklet that's got all the answers to all the questions you can possibly think of. And that's even if you just have preliminary questions, or I can do you one further and connect you with one of our local agents who lives, eats, sleeps, and breathes these markets that we operate in. Okay. And again, it's not just the market data, it's actually what's going on in that market. Hey man, this company came to town. Hey man, a lot of people are flowing into this neighborhood. Hey man, a lot of clients, a lot of tenants really like this builder that is building these new homes. We know those things because we do those things and we sell those things. It's what we do. And last, but certainly not least, reliable property management. I cannot tout how important property management is. There's definitely more ways than one that a bad property management company can take advantage of you as a landlord. And what we do here at Marshall Reddick, we actually took that property management, that big heavy load, and we took it in-house to avoid that at all costs. If you actually look at our rate buy down, our rate sheet for what we charge, it's completely geared towards investors. As we like to say, by landlords for landlords. You got to practice what you preach. So yeah, that's why we pick the markets that we operate in. And when I was talking about the A class, here is a highly recommended read for everyone here. It's a very short book, but what it does is it breaks down our experience as a real estate investment company over the past 40 plus years, and it's condensed into an easy, readable format of why we classify properties at the ratings that we classify them as. A must read for anyone here. If you haven't read it, ask me for a copy. If you can't find it, I will send it to you, or you can just go to marshallreddick.com/ebook. Highly recommended. It just makes the conversations that much easier. And last but not least, expecting from a consultation. I'll kind of wrap it up soon, quick after this, but a lot of people, they wonder what a consultation even is, and I want to tell you right now, every consultation is completely complimentary. We do not charge for consultations. We do not have a sign-up fee. We do not have any kind of expense, hence why everybody here right now, there was no cost. This is a free education, and we do free consultations as well because we make our business when our clients make money. So first thing we do is goal setting, right? The why. Next, we evaluate our options. So it's kind of like walking through the order of operations of what it looks like to actually buy real estate from somebody from like myself, who has done this with dozens and dozens, if not hundreds at this point, of clients over the past year who are looking to purchase real estate. We evaluate your options, i.e., looking at, well, do you want a single family? Do you want a duplex, fourplex? What are you really looking for? Decide on the time frame of when. Have you got a self-directed IRA that you've recently retired and you're looking to disperse those assets in the right way? Whatever you're looking for. Or hey man, I've just inherited $500,000 and I want to turn that into $6,000 a month. How do I do that? Well, got an answer for you. We're looking at the what, setting your criteria of what exactly it is you're looking for, helping you figure out what that is. The where, identify a market, and then the who, introducing you to all the key players. That is your local agent, that is your lender to get you pre-approved, that is your tax consultant at Robert Hall to help you get your planning set up. It is everything that you could possibly need. I like to help a lot of people understand this. Our specialty is helping people become landlords. We've been doing it for many, many, many years, and we're pretty good at it. And we just got to help people break that initial ice of that initial investment and show them exactly how easy it is to build that lifelong financial freedom and generational wealth. So please, please, please schedule a consultation. They're not that scary. We can help you, whether it's a first-time investor or it's your 60th year of investing, we can help you. anything else you can possibly want to know, feel free to check it out on the Marshall Reddick website. There is a ton of educational videos, articles, guides. Every single one of these webinars gets recorded and put back up on the website. So if there's anything that you need to really look up, you can find that there. There's also tons of the Marshall Reddick ebook is there. That's a great asset in and of itself, right? So all you have to do is go to marshallreddick.com/learn and you can get a wealth of knowledge, or like I said, schedule a consultation and I will give you that wealth of knowledge in a consolidated bite-sized form. Again, Tom Ahola, real estate advisor, realtor. There's my my number right there. But the biggest one is definitely going to marshallreddick.com/consultation. Or as I said prior, I've got a follow-up. Everybody, I like to talk to everybody that attends these things just to see exactly how it is that we can better help you, what kind of information we can relay to you, or what little nugget of something is going to help really increase your NOI. So reply to my emails or give me a call, give me an email, give me a text, whatever it is that you want to do, feel free to reach out. Like I said, no such thing as a bad question or a dumb question. I would love to help every single one of you. So without further ado, we're going to get to the stuff that everybody came here for. Holy moly, I had the attendees down and I pulled it back up. There's a lot of you here today. Tony, are you there?
I am here, ready to rock and roll.
All right, dude, let's rock and roll then. I'm going to go ahead and pass this over to Tony, and he is going to take you into the wisdom that is the use it or lose it. All right, Tony, thank you so much. I'm going to go ahead and mute myself and let you take it from here.
Great. Thank you so much again, Tom. You know, I've Tony Watson with Robert Hall and Associates here, obviously. I have known many individuals with the Marshall Reddick organization. I think I met Marshall himself about, gosh, I want to say maybe 13 years ago. I drove down to Orange County when I was first starting off doing seminars, in-person seminars, because this was pre-pandemic. Sat down and had lunch with him and realized very quickly that our mindset, our goal with our clients was one and the same, even though I work in a completely different industry, the tax industry. I realized, me personally, I realized very quickly when I first started as a tax advisor and a tax preparer that the tax industry and the real estate industry, they go hand in hand in more than just a couple ways. And so when I went down there and I met Marshall for the first time and met his staff at the time, I realized that it was a good relationship to really build on. And so Tom and everybody at Marshall Reddick, thanks again for allowing us to come on here and, like Tom said, give or allow our firms to provide you with free education. And I'll remind you about how to connect with us and the educational webinars that we provide, and a lot of it is really focused on self-employed business and growth. What you might consider to be tax savings advice. I personally believe it is advice on how to retain wealth. Because tax savings and wealth retention, they are pretty much the same thing. It's just one sounds a lot more sexy than the other, right? Wealth retention is a sexy topic. Tax savings, okay, we might listen for a couple minutes and then kind of figure that we have other things in life that we have to get to. But we are approaching the end of 2022. We're entering into this fourth quarter time period. We just passed the October 17th deadline season. 2021 is in the books. If you haven't filed for 2021 yet, no harm, no foul. You can still file. It's going to be a little late because yesterday was the deadline. But at the end of the day, you can still file. You have up to 3 years to file for any refunds. If you do have a liability, I would suggest meeting with your tax advisor as soon as possible and getting that filed, just so that you don't have any notices on the back end from Uncle Sam and whatever state you're filing in. Most of you, I assume, are here in California. But as we approach or enter into the fourth quarter, we are going to be talking today about year-end planning and the importance of putting a plan in place. Once again, my name's Tony Watson. I'm here on behalf of Robert Hall and Associates. Very honored to be here. I've been doing public speaking for, gosh, over a decade and a half now, I think. It seems like it was just yesterday that we started, but as a tax advisor, I've been doing taxes since 2000. I think I started interning here in 2004. And so, you know, we've just been cranking along, helping as many people as possible. I feel very fortunate to have worked through and helped a lot of my clients during the recession of 2006, 2007, 2008, seeing the people rise from the ashes, building wealth in real estate, starting new businesses. And then obviously we were hit by this darn pandemic a couple years ago, and we really cranked the webinar side of our marketing division and our education division. And we are on average providing about 140 events on a year-to-year basis. Once again, mostly webinars during the pandemic years, but we plan on starting up the in-person stuff, hopefully not too far, not too far along in the future here. But aside from tax preparation, I very much practice what I preach. I talk to people about tax preparation and the ability to shelter income in certain assets, how to make special elections, take advantage of cost segregation, the benefits of 1031 exchanges. And I'd say that this number's a little out of date, but in my individual column coming out of the 2021 year, I'd say that my personal clientele list probably north of the 500, maybe even 550 million in managed real estate and other business dealings. So I personally see a lot here in my own column, but I by no means am a one-man operation. I have got a wonderful senior staff I work alongside. This is a picture of our staff. We've got about 50 plus employees here at Robert Hall, and we do tax filings in all 50 states. So there probably isn't a scenario that we have not seen. We challenge people to ask us the complicated questions because that's what we thrive on. We thrive on figuring out creative positions on tax returns to interpret the code to help people retain wealth and not overpay Uncle Sam and the state agencies. Our firm has been around since 1971, so once again, we've seen a lot. I was Bob Hall's right-hand man, the founder of the company, Robert Hall. I was his right-hand man for the first 2.5, 3 years of working in the tax industry here at Robert Hall. Learned a lot about myself and about the Internal Revenue Code and how to assist clients with very complicated tax filings. And right now our firm services just over about 10,000 tax filings per year. We've got great reviews online, and we're well above $1 billion in real estate operations management and wholesaling tax filings. So once again, we do see a lot here. We are more than just a tax preparation firm. We also offer incorporating services. We do internal auditing, financial planning, bookkeepers that we can refer you to. And we just do estate planning, payroll services. I mean, all of kind of the one-stop shop needs and services that you might be looking for under one roof. So keep that in mind. I'm going to remind you about this towards the end. I do want to get into the bread and butter today, but we do offer free consultations, 30 minutes, either in person if you want to make the drive to Glendale, sunny Glendale, California. It's a beautiful day outside. If you want to avoid the traffic, we can do it by Zoom or Skype or however you want to connect with us. But we do, suggest that you send us 2 years of tax returns so we can review and see how you've been filing and what we would change if you did on board with Robert Hall. We'll check for any possible audit red flags on the return, anything that we would change. We do not, we are not afraid of going back and correcting other preparers' work as well. We do, if we find a mistake or something that was missed, we will go back and amend those issues on the returns and correct those. So let us check those out, 2 years of tax returns. And then also, if you're not looking for a new preparer, if you don't really want to onboard with another firm, at least take the opportunity to sign up for our free educational webinars. This is the best way to connect with us. And then you'll be put on an email list and you'll get the updates about when we talk about the power of Inc. Or obviously we're talking about year-end planning today, or other special topics, estate planning, cost segregation, power of Inc. Payroll processing, all of the above. So if anything, sign up with us just to be a part of that email list. So without further ado, we're going to hop right into the main topic today, the importance of year-end planning. And why do you think it's important to know your tax situation by year-end, right? The number one answer to that question is to avoid any unnecessary penalties and interest, because the government loves to collect more than what your obligation in tax is. They would love to collect more from you and assess you penalties and interest, because let's face it, that's how the government makes money. The IRS is the largest, in my opinion, privately owned collections agency in the world, right? They're owned by the federal government. They're there to do one thing and one thing only. It's to collect revenue for the federal government, the US government. Same with the state agencies. They are very difficult agencies to work with. However, I've called the IRS, on one hand and talked to somebody who wasn't willing to help. And because of that, I would hang up and then I'd call back and I'd get somebody who was willing to bend over backwards and who understood the trials and tribulations that people were going through during the pandemic year. So I guess it really all depends on who you speak to at the IRS. And make no mistake, by the end of today's webinar, we are going to talk about those 87,000 new agents and what my interpretation of all of these changes means for us as US taxpayers. But it's most important for people to understand what their tax return looks like before the calendar year end is even here, right? I mean, imagine this: if you could tell the future. Obviously, you don't want to know when your final demise is going to be, right? You don't want to know all of the information that the future holds for us. But shoot, if somebody came to me and said, hey, would you like to know what your tax return looks like before the calendar year end is even here? Well, I'd say, of course I would. I want to know what I'm up against. I don't like surprises, especially when it comes to paying taxes. Well, year-end planning that's exactly what we do with year-end planning. We put together a year-to-date analysis of your income, your expenses, any new acquisitions, potential elections or applications of unique tax sheltering benefits on the return, and we try to dial in that number exact. Obviously, it's going to be a buffer, maybe a couple $100, but we can dial in your year-to-date information so that you know what your tax return looks like before December 31st even rolls around, and that will help us avoid unnecessary penalties and interest if we need to make a prepayment before the end of the year, or suggest for the client to make that improvement to their rental property to help reduce cash flow against other rental real estate investments or other passive or non-passive income, and hopefully keep more money in your pocket and not overpay Uncle Sam, especially on the penalty and interest side. So this is the number one answer that I get when I ask people, why do you think it's important to talk before the end of the year? Well, I want to avoid penalties and interest. Some people say for positioning power, right? We want to set ourselves up for success. I love the saying, failing to plan is ultimately planning to fail, right? I'm sure that you've heard that saying before. I use it almost in every single webinar I've ever given. I think it rings true in the tax industry, in the real estate industry, in the legal industry, in the medical industry. You got to put a plan in place to succeed. Because if you fail to plan, you're ultimately planning to fail, and you're not going to like the results if you don't put a plan in place. So a lot of people say, well, I want to position myself for the greatest tax benefits. What can I do in this calendar year? What can I do after year end? Are there any elections that I can carry back to a previous year? Can I carry losses back to previous years? These are all great questions. And yes, in most cases with real estate investing, there are some really nice and sweet positions that you can put yourself in to help further reduce income, even when you thought you've done everything possible in your power to reduce tax liability and taxable income. So keep that in mind. It's all about positioning. And number three, people say they want peace of mind, knowing what the results are before the tax appointment. That way, when they leave the conversation or the appointment, they already knew that they were going to either get this money back or owe it or break even. That's probably the best scenario overall, is not to overpay, not to underpay, but to break even. That means that you maximize the money in your bank account throughout a 365-day period, paid your obligation in tax, and not a penny more than that obligated amount. That's the goal with the planning side of the tax industry. I call it an interview, the interview process, where when I meet with clients prior to the end of the year, I have to interview them. I have to ask them, okay, well, what happened throughout this year? Back in January, February, March of 2022, what did you purchase? Did you buy a new car? Did you buy new computer equipment? Did you buy office furniture? Did you start a new LLC? Did you inherit money? Did you roll over a retirement account from one account to the other? Did you start a new retirement account, start new jobs? Did you have a child? Did you get married? I mean, these are all things that can impact your bottom line. And in this interview process, we always want to dial in a bottom line and figure out, hey, if we make a prepayment for this projected liability, how much is it going to save you in penalties and interest? What are you required to pay? I have a lot of real estate investor clients. In fact, I'd say 95% of my personal clients are real estate investors, and there are some other senior preparers here who are real estate specific as far as tax preparation is concerned, also entity and incorporating specific tax preparers and advisors. But I always want to make sure that people understand their rights as taxpayers. Do I have to prepay my liability? And if so, how much of it do I have to prepay? Well, the Internal Revenue Code specifically states that you either have to cover 90% of your current year liability, so 2022's liability, or you have to prepay 110% of the previous year's liability, whichever is greater, in order to completely avoid penalties and interest. Now, that doesn't seem fair, right? I mean, if in 2021 my revenue was through the roof because I closed, 10 property deals, I got paid commission income, my cash flow is increased, I got a bunch of these rent relief checks from the county or the state. So all of a sudden I'm looking at this massive liability in 2021, but then everything dialed back in 2022. So obviously, if you're paying 110% of the previous year's liability, you are going to significantly overpay your tax and then wait for the government to refund you that money. So throughout the year, most importantly at the tail end of the year for year-end planning, we need to figure out where you're at prepayment wise. Have you overpaid? Have you underpaid? Have you paid just enough? And what is the power of keeping that money in your pocket as opposed to prepaying? I'm not telling all of the attendees today not to prepay their tax, but I'm telling you that some real estate investors choose not to prepay their tax, knowing full well that they're going to get hit with some penalties and interest on the back end. But if the ROI on keeping your money, let's say you do gap funding or you do some day trading, and obviously that's been popular, but not over the past couple months with the market where it is. But let's say that your ROI personally for keeping those funds and your other unique investments, ROI, let's say, is 10 to 15%. And on the back end, just by keeping that money, maybe there's a penalty and interest amount of 1.2 to 1.4%. Well, I mean, personally speaking, I'd rather keep the money and invest it, having the 10 to 15% ROI. And sure, I'll pay the 1.4, I'd pay 3 to 4% penalties and interest if I was making 10 to 15% ROI just by keeping my money. Once again, I'm not telling you all to do that, but I want you to understand your options as taxpayers. Yes, the government in theory wants you to pay 90% of the current year liability or 110% of the previous year's liability, whichever is greater. But if you don't do that, you're not going to go to jail. Okay, the government suggests this because they want you to avoid penalties and interest, but I can tell you right now, a lot of my clients are investors. They need that cash to close on deals. They need proof of funds. They need money circulating and more lines in the water in their own investments. The more lines you have in the water, the more bites you're going to see. It's a simple plan of fishing, right? I try to have as many lines in the water as possible, and if any of them bite, I know that the ROI is going to be greater in these investments than what I'm going to pay on the back end for penalties and interest. If you want to dial in a plan like this, you should be talking with a tax advisor. This is what we do outside of tax season. We do tax planning. That's what a tax advisor is there for, not just to file your individual and your business tax returns, but to advise you on the back end to make sure that you're making the right financial decisions with your money and that you understand your rights. That's probably the most important. For employees, it's a review of your exemptions, right? For self-employed individuals, it's year-to-date income, year-to-date expenses. For employees, it's a little bit different. We want to see an updated pay stub. We want to see what exemptions you're taking from payroll, how much you've already withheld in federal and state income tax. And shoot, if you're looking at an overpayment, maybe go exempt on the last 2 or 3 months of payroll and take the money home now rather than waiting until you file in filing season to get that money back, right? Because cash is king. Having that money available to make unique financial decisions with Marshall Reddick and their team, to buy and purchase those real estate investments, to invest in syndications, to develop and improve property. That could also be another case of wealth retention for you because you are accessing those funds now rather than having to wait for the government to refund that money and send it to your bank account. And trust me, they will delay it. The government has been delay over the past 2.5, 3 years. So we've been doing a lot more planning during the pandemic years and mostly coming out of the pandemic years, just making sure that people are positioned the right way. Now, as we enter into the tail end of 2022, we're thinking about 2023's tax season, right? What can we spend our money on business-wise, real estate investment-wise, to get a great dollar-for-dollar reduction in taxable income? What are some of the top tax deductions for real estate professionals, real estate investors coming out of this pandemic? I'm going to tell you right now that during the 2.5, 3 year period, let's see, we shut down the economy, March 15th of 2020, and we've been doing things remotely for the most part. I mean, we're back in our office now, thank goodness, but for a long period of time, people were working from home. They were afraid to go out. They were afraid to shake hands. They were wearing masks. They were getting vaccinated. Whatever you were doing during the pandemic, I think one thing was pretty common amongst the general population is that there was fear. right? There was fear in moving forward. How do we come out of this in a better position than where we're at right now? How do we keep that forward momentum going? I'll tell you this right now, my business owners, they pumped a lot of money into marketing and advertising for their businesses. When they had a vacancy, they immediately went online and blasted their vacancy to the general public to fill that spot. Now, here in Southern California, well, in the state of California, we did have the eviction moratorium that should be ending at the tail end of this year. That's a whole other topic. It was completely unjust, unfair. I just can't even imagine. My heart goes out to the real estate investors here in the state of California who were providing free housing for people, and they didn't really have any power over that. We saw some evictions happen during the pandemic because of very specific rulings that attorneys could file in a court of law, but even those filings in a court of law were delayed because courts were closed and judges weren't coming in and paperwork wasn't being processed. But when people were working from home, they couldn't door knock. They couldn't shake hands. They couldn't go to networking events. And when they were on Zoom, a lot of people weren't really grasping the concept of still connecting with people digitally. Education has been a very, very important thing for our firm during the pandemic years, but, connecting with people on a whole new level, emotionally and that human connection just was lost, in my opinion. But marketing and advertising happened to be one of the largest expenses for my business owners because they couldn't door knock. They couldn't go to these networking events. And the clients that I've seen for filing for 2021 that spent 2, 3, 4x on their advertising and marketing expenses, their revenue did not take a step back. Their forward momentum was very, very strong, and their net revenue continued to increase from 2020 to 2021. And now they have set themselves up for complete success in 2022. And they are still, that engine is roaring into the end of 2022 and will continue in 2023. The great thing about marketing and advertising is not only does it allow you to generate more revenue and more traction with potential clients, but it is a dollar for dollar tax deduction against self-employed and rental income. This is what we're looking as tax advisors for. We're looking for those dollar for dollar adjustments. So make sure that you're maximizing these expenses on your Schedule E's, your Schedule C's, your LLC filings, your S Corps, your partnerships, whatever you file, make sure that you are not losing out on this great dollar for dollar write-off. Another thing that we saw a lot of purchase-wise was in home office expenses, right? Supplies and equipment. And let's face it, this is probably one of the most common write-offs for business owners, because how many people in today's webinar, for instance, can do what they do professionally without a computer? I mean, how are you logging in today, right? You're logging in on a cell phone, on an iPad, or on a computer screen, right? So you know that these are some of the most common write-offs, and more importantly, during the pandemic years, people started working from home. They needed upgraded equipment. They needed desks. They needed chairs. They needed filing cabinets. They needed pens and paper and ink and all of these professional supplies and equipment purchases. So in 19 years, to be real honest with you, real transparent, in 19 years that I'm going on, just knowing about the tax industry, working with clients and preparing thousands and thousands of tax returns, I've realized that the government knows that this in particular is probably one of the more common expenses that a business owner is going to have. And I have yet to see an audit on a computer purchase. I've yet to see an audit on a cell phone purchase and a desk purchase. Now, if you're going out and you're buying a $10,000, $15,000 desk, okay, understandable, that's a little bit higher of an expense, still has a reduced risk for audit because it is a legitimate expense. But the size of the write-off might throw up a little bit of a red flag. But at the end of the day, if it was a true business deduction, do not be afraid to take it. These are great overall tax expenses, tax deductions for you to take to help dollar for dollar reduce overall taxable income. Car and truck expenses. I'm sure that you've all seen the value of cars just skyrocketing. I mean, my car right now, I looked online a couple weeks ago just because I was intrigued as to how much I could get from my car. And my car, with the amount of miles on it, the year, the make, the condition, I mean, I'm looking at possibly, making 10 grand in profit selling a car that I've used over the past 2.5, 3 years since I bought it under my business. So, we've seen car and truck expenses really change big time during the pandemic years, mainly because of supply chain issues, because of certain parts of the tax code allowing accelerated bonus depreciation on work vehicles. So, car and truck expenses, great dollar for dollar write-off on the federal side from a depreciation standpoint, or from an actual auto and truck expense, oil changes, tire replacements, engine repairs, all of those. If you're going to go with the mileage deduction, you get a certain cent per business mile as a write-off. But at the end of the day, the big bang for your buck, especially if you're a self-employed real estate professional, is probably going to be the purchasing of a vehicle. I'm sure that you've all heard since 2018, there's something in the Internal Revenue Code called bonus depreciation, 100% bonus depreciation that qualifies on, the qualifying asset at that point would be a vehicle that weighs over 6,000 pounds. I'm sure that most of you have heard this part of the rule, but it is true that, starting in 2018, if you had a business and you went out and you purchased a new vehicle, let's say it was a GMC Yukon or a Chevy Tahoe or a Silverado or a GMC Sierra truck or even a Sprinter van to drive, for business use, and you're driving around clients to see properties. These vehicles weigh over 6,000 pounds and they qualify for a 100% deduction benefit on the federal side of your filings. California does not conform to this part of the Internal Revenue Code, but imagine this. If you're making $400,000 in net profit and you're asking your tax advisor, what else can you do? You've already maxed out your deferred retirement contributions. You've made all of the improvements to your properties. You've accelerated real estate depreciation as much as possible. And you're sitting there thinking, what else can I do to help reduce this $400,000 of cash flow or taxable self-employed revenue? Well, if you're already in the market looking for a vehicle, I'm not going to send people out just to buy the vehicle for a tax write-off, but if you're already looking to upgrade a vehicle, why not go out and purchase a heavyweight vehicle, something that weighs over 6,000 pounds, and take that fully as a dollar for dollar write-off to offset taxable income, right? You buy a $65,000 GMC Yukon, that's a $65,000 dollar for dollar write-off against your self-employed revenue. Great overall tax deduction. And so I'm sure that people have questions on that, and also we do offer free consultations. So definitely take a look at, or I'll connect you at the end here. I'll give you our contact information and we can connect and see what kind of benefit you can get from this particular deduction. But we saw a lot of car purchases during the pandemic year. That was all part of the car and truck expenses. Number 4, legal and professional fees. Whatever you pay an attorney, whatever you pay a realtor and commission income, whatever you pay your accountants to file your tax returns or incorporate your business, starting LLCs, S Corps, C Corps, great dollar for dollar deductions on Form Schedule E, Schedule C, and your entity returns. So make sure that you understand the differences between deductions against W-2 income and deductions against self-employed income or passive, non-passive income investments. In 2018, for instance, employees lost all of their non-reimbursed business expense deductions on the individual returns. California did not conform to that. So California will still allow an employee to deduct their internet charges, to deduct their cell phone purchases, to deduct their meals and entertainment. But the federal government, starting in 2018, no longer allows us to write those off if you're an employee, a W-2 wage earner. If you're self-employed, you're still allowed these deductions. So understand the differences between, what revenue streams really mean as far as deductions and sheltering is concerned. What is the best type of revenue from a tax perspective? What's the best type of revenue for you to have and allow you to keep more of the money in your own pocket and retain wealth? That's self-employed income and rental cash flow. Those are the two main revenue streams that I would love every single taxpayer to have, because that's where all the tax sheltering benefits really, really apply. There are parts of the Internal Revenue Code for real estate professionals that date back over 100 years. And some of those were on the chopping block under the Inflation Reduction Act. Thank goodness a lot of those didn't pass. But understand the difference. Work with tax advisors that understand how to maximize these positions to keep more money in your pocket. Last but not least, property deductions. A lot of people started working from home, as I said earlier. So do not be afraid to take this in-home office deduction on your return. I can't tell you how wrong and incorrect that advice is for people to say, well, we shouldn't take the in-home office deduction because it increases your risk for audit. I'll tell you right now that it's not the form that gets people audited. It's the unreasonable allocation of square footage. I'll give you an example. Let's say that you live in a 4,000 square foot home and you think industry average for in-home office space is 25%. Well, if I live in a 1,000 square foot space in Los Angeles, because that's pretty much all people can afford these days, unless you bought 20, 30 years ago. But if you live in a 1,000 square foot place and you put 25% as an in-home office, okay, 250 square feet, reasonable size office space. But if you live in a 4, 5, 6,000 square foot home, you're looking at an in-home office allocation at 25% of over 1,000 square feet. Now, if that is true, and you've measured it and you said, Tony or whoever your tax advisor is, this is true, I've measured it, this is including the nearest restroom to the office space as well, then we'll take it, because in-home office deductions are ordinary, necessary, and legitimate. and let your tax advisors argue that if it is ever questioned by the Internal Revenue Service. Let us represent you in front of the Internal Revenue Service. That's also what we're here to do. But don't be afraid to take the write-off. Just be reasonable with the allocation amount. It is very much an ordinary, necessary, and legitimate write-off to have an in-home office. Do I think that coming out of the pandemic, in-home offices will continue to have a high risk for audit? I think they'll always have a high risk for audit because of the unreasonable allocation that taxpayers tend to take. But as long as you're being reasonable, you should have no problem taking that deduction, no increased risk for audit, as long as you have that reasonable allocation squared away. And have this conversation with your tax advisor, but do not avoid the deduction. That's the worst thing that you could do, is take the advice from a tax advisor that says you shouldn't take this as a deduction because it has an increased risk for audit. No, that's the wrong approach. You should be taking it and being reasonable with the allocation, or measuring it to make sure that your allocation is correct and not just an estimation, and allowing yourself to dollar for dollar reduce some of your self-employed revenue streams and helping you retain more of that wealth, that hard-earned wealth that you've built for yourself over the past 365 days or whatever set period it is. Starting in 2018, actually dated back to December 15th of 2017, the code changed for mortgage interest write-offs. On a primary residence, for instance, your mortgage interest is limited. You are only allowed the mortgage interest deduction on the first $750,000 of debt on the federal tax side, on a primary residence. On California side, they did not conform to that change in the Internal Revenue Code. On the California side, you're still allowed your primary residence mortgage interest deduction on the first $1 million of acquisition debt. So you get to deduct interest on $250,000 more of debt on the state side, but you have to limit yourself on the federal side if that primary residence, or even a second home, not a rental property, but a second home, if it was purchased after December 15th of 2017. If you bought the home prior to that date, you are grandfathered into the old Internal Revenue Code, so don't worry about it. You still get the dollar for dollar write-off up to, once again, the allowed allocable mortgage interest of $1 million, okay? I'll tell you right now, where did the IRS come up with this change in 2007, December 15th of 2017? How did they come up with 750,000? Because at first they were going to leave it at $1 million, then they were going to drop it to 500,000, and they ended up at the 23rd hour just limiting the interest to the first $750,000 of debt. Well, this is federal code, right? Because California didn't conform to this. The federal side, they took a look at all 50 states, and they found that the average mortgage debt on a primary residence across all 50 states was about $500,000, okay? And a majority of the mortgages, if not a greater percent of the mortgages that were over 500,000, were in states like California and New York and Hawaii. So remember that this is a federal code change, a federal limitation that's across all 50 states. So the other 47 states probably didn't see much of a change on their tax returns because their mortgage debt wasn't above 500,000 or above 750,000. So you have to understand that when the federal government changes Internal Revenue Code, they're changing it for all 50 states, not just for California, New York, and Hawaii. They weren't thinking when they were writing this code, poor Californians, they're going to lose write-offs, even though they should have been, because Californians pay a lot of federal income tax. We are the supporters, New York and California, we're the supporters of the US economy. We are spenders. We have high valued real estate. We make and generate a lot of revenue, and we pay into Social Security and Medicare and state disability and unemployment insurance and employment training tax. We invest elsewhere and improve property elsewhere in the US. So I was very frustrated to hear about this change. It is still in place, but it is only a limitation on a primary residence and a second home, not on rental properties. That's the power of business, right? Business deductions are not limited. So therefore, on your rental property, you have no limit to what you can write off in mortgage interest. You have no limit on what you can write off in property taxes. So don't get this screen confused with the SALT limitation. SALT meaning state and local taxes. That's still capped at $10,000. They had put in part of the Inflation Reduction Act to change that and increase to 80 grand. That did not pass. It is still at $10,000. That has nothing to do with your mortgage interest. These are two completely separate topics. So understand that your property taxes and your state and local income tax that you pay through W-2s or on 1099-R retirement distributions, whatever you pay to the state, that plus your primary residence property taxes is capped at a federal write-off of $10,000. The mortgage interest is not part of that $10,000 cap. And when you have property taxes on rental portfolios of, let's say, 30, 40, 50 grand across 10 properties, you get the full 30, 40, 50 grand in property tax deductions. because there is no limit to what you can write off against a business. And in this case, your business is a rental investment. Now, whether or not you can deduct the losses through your real estate portfolio, that's a different story. In order for you to fully be free from any limitation on the loss deductions, either you or your spouse have to be a real estate professional. You have to make this election on your individual return. As a real estate, there's a box on your tax return that says real estate professional. And that allows you, whether you make $1 million of income or whether you make $100,000 of income, it allows you to fully deduct your real estate rental losses on your portfolio. However, if you and your spouse, or if you're filing single, if neither of you or you are not a real estate professional and your income, your adjusted gross income is above $150,000, the federal government says that if you're not a real estate professional and you make over 150 grand, you are not allowed any of your real estate portfolio losses. You don't lose them, you just can't use them. And so they become part of what's called an unallowed passive loss carry forward, and they carry forward into future years to offset future revenue. Now, let's say that 5, 10, 15 years down the road, you've never been allowed your losses because you and your spouse, or just you individually, are high income earners, and you've never been allowed this loss deduction. 10, 15 years down the road, you decide that you want to sell one of your real estate investment properties that has unallowed passive losses in the year of sale. You get to fully dollar for dollar deduct those losses to offset any gain on the sale of that property. So this, once again, comes full circle back to proper tax planning. I have seen clients set up a plan, a 10-year plan, to where they acquire as much real estate as possible. They enjoy the appreciation of the value in the markets. They tap into equity. They diversify their investments, all in the meantime not being allowed these loss deductions after mortgage interest and depreciation and property taxes, improvements, travel back and forth, management fees, all of these things. And let's say that at the end of this 10, 15-year period, they decide they want to exit out, enter into retirement, travel the world, play golf on a private island somewhere, whatever you want to do in retirement. As you can see where my mind's at, I want to live on an island away from everything and play golf for the rest of my life in retirement. That's my goal, folks. But you know, at the end of the day, let's say you want to exit out of real estate, sell everything. You might not have to 1031 exchange everything because you've got these banked up losses over a 10, 15, sometimes 20-year period. And those losses in the year of sale become fully dollar for dollar tax deductible, whether you are a real estate professional or not. And it doesn't matter what your income is. It's called a 4797 business loss, and it is a direct dollar for dollar adjustment to all income sources. Okay, so once again, proper tax planning is key if you want to make and retain wealth in the real estate and self-employed industries. Do you have to make estimated tax payments? I mentioned this a little bit earlier. You don't necessarily have to prepay your taxes, but you want to sit down with your tax advisor prior to the end of the year and just see what you're up against, especially if you've inherited assets, if you've increased revenue streams, if you've moved out of a position and you're making less. Do you really need to be prepaying all of these taxes if your income is on a decline? There's a million scenarios that we could go over, but it all comes back to proper year-end planning. So keep that in mind. Do you have to make estimated tax payments? No, but to avoid penalties and interest, to make sure that it's not the snowball effect of having to pay a massive liability at the tail end of the year, you might want to throw some bones to the IRS, so to speak, and just have some credits in the system. But talk with your tax advisor about how to map out that plan and that strategy. Something that's really unique and actually has been around for over, gosh, I think what is 2022, for almost, I think it's over 40 years now, is self-directed retirement investing. So some of you might have traditional IRAs, Roth IRAs, 401ks, investment accounts and retirement accounts that invest in the US stock market. And obviously, if you do invest in the market like I do, you've been watching the market pretty closely over the past couple months. There's no good news on that end, unfortunately, but you can actually diversify outside of the stock market and have a portion of your retirement income invested in real estate. Marshall Reddick and the team at Marshall Reddick, they introduced me, once again, 13 years ago, to a gentleman named Dmitry Fomachenko. He is like the master, the wizard of solo 401ks. And we've done a lot of business together. I've referred him a lot of business because he's just the mecca of solo 401k specialists in the industry. And he taught me very early in my career of the benefits of purchasing real estate within retirement accounts or in a retirement account. Much like a stock transaction, right? If you bought Google at whatever the beginning price was and you made $1 million in Google, well, as long as you're not distributing the money from your retirement account, all of it's tax deferred, right? Until you retire. Same concept, but with real estate. You purchase a property under an IRA or under a self-directed IRA or a solo 401k. The property's cash flowing like crazy. 10, 15, 20, 30 years down the road, you sell it for a big gain. All of that money goes back into your retirement account. You pay absolutely nothing in tax on that gain until you retire and start distributing that cash to yourself. So you can diversify your retirement portfolio into things that you believe in. And I was telling Tom this right before we started the seminar tonight, that I know for a fact that as a real estate investor myself, as an individual who grew up in a real estate investing household, my father, my mother, they were both real estate investors. My grandfather, my great-grandfather, they were all real estate owners, rental investors, and business owners. And so I learned very quickly that whether the economy is good or bad, people will always need a place to live, right? That's the beauty of real estate. Whether the economy is good or bad, people will always need a place to live. Sure, we have this issue with higher interest rates, and we could talk about that topic until we're blue in the face, but I have a lot of clients who remember 14, 15% interest rates, right? And I'm not comparing, because it's apples to oranges, different times, different, economics overall, just a different overall era and economy that we're living in right now. But it is true, interest will fluctuate, and who knows how long it will take for the interest rates to come down. But if you ignore that part of the market, you have to understand that real estate historically has always gone through its ebbs and flows. It goes up, it goes down. And people said that it couldn't get any worse than what it was in 2009, 2010. And then we saw a market kind of skyrocketing during the pandemic because the federal government froze interest rates at such a low rate. I had clients locking in 2.6% 30-year fixed rates. I mean, it was like winning the lottery, right? And now we're up north of 5, maybe even 6% right now. It will come back down, but at the same time, when you buy investment property in your retirement account or individually under your primary social security numbers or under entities, somebody else is paying for that property on your behalf. They are paying down the debt, they're paying for the property taxes, they're paying for the improvements, and you're going to enjoy that long-term appreciation over the ebb and flow period that we've seen historically, dating back to when stats on this was, first came about. We see that those historical values. So just understand that in my personal opinion, it's never a bad time to buy real estate. It's just a matter of making sure it's the right time for you individually, financially speaking. You don't want to get in over your head. You don't want to overpay for property, which I have a lot of conversations about that these days. People feel like they're overpaying, but like Tom had mentioned in his beginning comments, there are options outside of California. My brother and I own real estate investments in Austin, Texas. We got into the Austin market at a very good time back in 2007, 2008 through a 1031 exchange. We're very fortunate. But I have not stopped looking for real estate. Now we have Airbnb and VRBO and all of these vacation rental sources where I have some clients who generate a full year's rent during the summer months of the calendar year. There's a lot of opportunity. I don't want to talk too much about this, but just understand that these are all options for you, but you got to look at the financial side of things and make sure that it's right for you. Once again, in my opinion, never a bad time to buy real estate, especially if you have an old 401k sitting with Northrop Grumman or an old 401k sitting at Walmart. You have a nice retirement nest egg sitting there. Why not take some of that money, roll it into a self-directed IRA, solo 401k, and start purchasing real estate and enjoy the long-term appreciation in the cash flow, the most consistent dividend-paying investment, paying you dividends that are tax-free within a retirement account, okay? I think I've spent enough time on that slide. I want to mention a couple things about the Inflation Reduction Act. Some of the craziest things that have been talked about since October of 2021. This is how long we've been waiting for the federal government to really fine-tune what again was termed as the Inflation Reduction Act. I don't know how much reduction it's going to create, but let's squash some misconceptions really quick. What exactly has become law so far? Well, a lot of things have been rolled out. A lot of things have been signed off, and I know Biden had signed off on the Inflation Reduction Act. I think 2 months ago. I think it is now. Maybe a month and a half ago, but a lot of these particular parts of the Inflation Reduction Act, what is called the IRA, so don't mistake that with an individual retirement account. IRA also means Inflation Reduction Act. So when you hear people talk about the IRA, they're talking about either Inflation Reduction Act or a retirement account. So make sure that you understand what they're discussing. We will see the IRA, the Inflation Reduction Act, change and be amended and corrected and altered, probably, no joke, what I assume to be probably 40, 50 times that it will be corrected and adjusted over the next 2 years. We saw it in 2017 and 2018 with the 2018 tax reform bill. I had counted, I'm sure it was more than this, but I had counted 37 changes to the 2018 tax reform bill after it was passed. And you know, the government's going to figure out what works, what doesn't work, what is good for the general population, what isn't good for the general population. They're going to change all of these things, but what actually is set in stone as of today? 1031, Section 1031 of the Internal Revenue Code, the 1031 tax deferred exchange, nothing has changed. Thank goodness. This part of the Internal Revenue Code has been around for over 100 years. It changed in 2018 slightly to limit your exchange capabilities to only real property, right? Because in the past, you could exchange a tractor for a dump truck. You could exchange a work asset for a business asset for another business asset. It didn't actually have to be property. In 2018, Section 1031 was defined as only real property that could be exchanged. Okay, and then all of a sudden last October, they started talking about limiting the deferral of taxable gain and limiting it to $500,000 per taxpayer. 500,000 if you're single, $1 million if you're married filing joint, so $500,000 per person. And people were up in arms. This is an industry, by the way, 1031, the like-kind exchange industry. This creates, I think the last stat that I checked was over 630,000 jobs globally, generates over $40 billion in consistent taxable collections on the federal government side, and makes up for over, gosh, I think it was 65% of all real estate transactions here in the United States. I mean, we're talking about a massive industry that could literally come to a halt if people were limited to $500,000 of gain. I mean, at least that's what we thought here in California, because we as Californians will see gains of over $500,000 and $1 million. Just understand that this was a federal tax code change, so they were coming up with these numbers based on all 50 states. So it wasn't too far off. You know, they were just not really keeping California and New York and Hawaii at the forefront of their thought process, thinking, oh, poor Californians, poor New Yorkers, they're really going to get hit by this change. But at the 23rd hour, the federal government decided not to change or alter Section 1031. That is a massive win for real estate investors. New bonus depreciation rules, the 100% bonus depreciation is going to drop to 80% and then to 60%. I believe that that will also change with the way the economy acts, you know, on the equipment purchase side, on the vehicle purchase side, on the cost segregation side. So we'll have to see where the dust settles around that. One of the major changes that I am absolutely furious over is the change to the cap gain rates. Here in California, let's say, I'll give you an example. Let's say that you and a spouse own a property in Orange County and you want to sell it and you don't want to exchange it, and you're looking at, let's say, $800,000 of capital gain plus $300,000 of recaptured depreciation. I'm just throwing out some numbers for ease of calculation. So you got a $1.1 million gain, and that's not including any of your W-2 income, retirement income, Social Security income, you know, all of the other income sources that you have. And all of a sudden, this $1.1 million gain on the sale of property puts your household income well above $1 million. Let's call it $1.6 million that you're sitting at, just to give you an example of how this works. Under the Inflation Reduction Act, any dollar of capital gain or investment income that bumps you above as a married filing joint couple above $1 million is going to be taxed at a long-term capital gain rate of 39.6%. That's not including state either, right? So you're saying, Tony, that if I'm at $1.6 million and my capital gain is, you know, $1.1 million, that means I'm $600,000 over $1 million. That $600,000 going to be subject to 39.6% federal capital gain tax. That's exactly what I'm saying. So 39.6% plus another, what, 10% on the state side, you're looking at close to 50, oh, and that's not even including 3.8% net investment tax. You're looking at over 50% of $600,000 paid in long-term capital gain tax. Anything below the $1 million threshold for a married filing joint couple would be subject to the current rules, 20% federal and 3.8% net investment tax. For a single individual, that threshold isn't $1 million though. For a single individual, it's $500,000. You sell a property, you have capital gain, it puts you above 500 grand. Every dollar above 500 grand subject to almost 40% in capital gain tax. So planning. I can't stress that enough. If you are thinking about selling a property and you're talking to the team at Marshall Reddick, you know, they're gonna talk to you about the exchange. Seriously consider exchanging property, or maybe not doing a full exchange, but maybe a partial exchange where you exchange a portion of the gain and maybe access the cash that you need. instead of accessing the full gain and paying just an unrealistic and ridiculous amount of capital gain tax to Uncle Sam and the state agencies. So I can't stress that enough. Energy credits moving into 2023, the solar efficiency credit is increasing to 30%. We're going to see a lot of people making improvements to their homes. And remember that this 30% solar improvement credit not only is included on the solar panels, but it's also included on the new roof cost. Okay, so if you have to redo your roof at the same time that you get the solar system installed, 30% of that is a dollar for dollar federal tax credit, massive credit. So we're going to see a lot of that in 2023 as well. Updates on new IRS employment. I knew this was coming. I get this question a lot. What's going on with the 87,000 new agents? I have a quick just snippet for you just to explain what happened in the pandemic years with IRS employment. At the bottom of the pandemic, and who knows when that exactly was, but I've read enough articles to know that what the government considers to be the bottom of the pandemic was sometime in 2021, the federal government employee numbers dropped to 35,000 employees here in the United States. At least that's what their numbers have told us, 35,000 employees. When on average, they've kept about 70 to 80,000 employees just on staff on average per year with the Internal Revenue Service, and they hire and fire based on the seasonal filings or filing seasons and whatnot. So understand that when they hired these new 87,000 employees, they have to train them, and they are mostly to fill seats that were empty because of the pandemic. And the federal government has also been very transparent about the fact that they expect by 2026 for at least 65% of their agents to go into full-blown retirement. So they are trying to set themselves up to not have a drag or a lag in their processes. I know that it's scary because the media outlets love to scare us at any corner. They give us, just feed us information of fear, that we should fear all of this. That's what's happening. Well, I'm not fearing this, because I've studied enough of the statistics. I worked through the pandemic. I dealt with the IRS. I sat on hold for 3-4 hours sometimes waiting to talk to an agent or a branch manager. And I understood that at one point the federal government was over 3 million documents behind in processing, and that was hurting our clients. Lenders couldn't pull wage and income transcripts. They couldn't get verification that a return was processed. Some people had identity theft pins, and without that ID theft pin, they couldn't electronically file. So they had to paper file their returns, which took 3.5 to 4 months just for the government to even mark it in their system as being received. I mean, it was an absolute nightmare. With these new employees, they are starting to catch up on all of that unprocessed work. Some people are still waiting on 2020 tax refunds. It's very sad. And we call the IRS time and time again. We follow up on these things, and agents will say that they've done something. They say that they've processed something. And I'm not going to say that they lie, but it almost seems like some of them do. And that's why we call, and if we don't get what we want, we hang up, we call again, because we'll get a whole new person on the phone, somebody with a different personality, somebody who wants to help at a completely different division or in a different state, willing and readily available to help us. So this new IRS employment, I'm not worried about the increased audit numbers. In fact, they said if there is going to be an increased audit percentage, those numbers won't hit until 2026, 2027. So we've got some years to build case study. That's exactly what we do here at Robert Hall. We look at stats, and we manage our files and manage our accounts by statistics. And we figure out what the government's focusing their attention on, what they are making a big deal out of. We try to educate ourselves at any corner as to what's changing, what we should implement, what will help reduce liability but not increase risk for audit. It's very important for your tax advisors to be following along with all of the changes. And trust me, there will be more changes in the upcoming year to 2 years. So just keep that in mind. Don't fear it, just work with the right professionals. Work with people at Marshall Reddick for your real estate needs. Work with our senior preparers here at Robert Hall for any questions that you might have. I did want to end on this screen just to remind you that we do offer free 30-minute consultations. If you want to take the drive up to Glendale, we are open for in-person consultations. I know that it is a long drive, and LA traffic is getting back to its annoying, 2 to 3 hour drive from some places on the west side in Southern California. So maybe Zoom or Skype or FaceTime or even by phone is easiest for some of you who are further into the Southern California area. We do file taxes in all 50 states. Our licenses here at Robert Hall allow us to file taxes in all 50 states. So that's why I think Marshall Reddick and Robert Hall work so well together, because they have investors outside of California, or they have California investors who buy property outside of California. We can assist with all of those other state filings. I'll mention this one more time. We would like to see 2 years of tax filings just to kind of review those and analyze what's been filed in past years. Hopefully you have 2021s already because it was due yesterday. We'll check for possible audit triggers. If we need to correct anything, we will do that, or we'll advise you to do that. But most importantly, get on our email updates and get updates as to when our free educational webinars are. We'll be back with Marshall Reddick before we know it. As soon as there's another change or something that needs to be talked about, we'll be back right with you with all of the updates. And that's really what I wanted to leave you all with. And Tom, I thank you, everybody at Marshall Reddick. Thanks, Tom, for allowing us to hop on here and share our information. Very, very honored to be here tonight. And hopefully there will be a lot of questions that come through, but if you want to connect with me, this is the best way to connect with Robert Hall & Associates. If for some reason my schedule doesn't match up with yours, like I said, I'm not a one-man operation. I've got a wonderful senior accounting staff that I work alongside. Most important thing is to get the answers to your questions. So do not hesitate. Contact us as soon as possible so we can get you those answers. Tom, I'm going to hand it back over to you and we'll wrap this thing up.
Thank you so much, Tony. I greatly appreciate it, man. Every time I sit in on one of these, it's like you've got some new information. I know you and I are chatting all the time, and you're chatting with us here. We're chatting with you there. But it's like I'm sitting here like my little world's getting rocked, like, oh, that's an update. Oh, that's new. Oh, my gosh, what's going on here? So, I mean, I cannot stress enough with how many years we've worked with these guys and they've worked with us back and forth. It really does behoove you. Sign up for a free consult with them. It would be exponentially worth more than any, even if you're making $100 an hour, $200 an hour, whatever you value your time at, it's exponentially more valuable just to give him 30 minutes of it because you will get so much more than that back. Also, like you saw before, I'm going to be reaching out, sending email follow-ups, call follow-ups, just checking in with everybody, see how everyone's doing. I greatly appreciate everyone being here tonight, especially you, Tony, and all of these Marshall Reddick clients. Thank you for taking time out of your busy schedules, and we hope to see you making some major moves in your real estate investment portfolios coming here shortly in the future because it is time for opportunity. So again, thank you. Have a great rest of your night, and I will talk to you all soon.